projecting financial statements, basically projecting growth and sales revenue. And the second, we had seen a very comprehensive case study where we looked at a startup, how the balance sheet would look like, how the income statement would look like, then the production schedule, cost of goods schedule, inventory schedule, then the survival revenues, how they are calculated, and of course the cash flow statement as well. Okay. So we finished all of that, and now we will go through some numericals. Now it is very difficult to get numericals which are based only on startups. So there's one book that I've suggested as a textbook also. It's very good, by Leach and Melcher, and they unfortunately only had numericals. They didn't have any solutions to the numericals. So what Samriddhi and Harshita did was that they solved all these numericals for you, and we have put it in a PDF for you. Okay, so we will go through different kinds of numericals, and of course there are many more numericals which are there for you for practice. The solutions of all of them have been made and given to you. I've already uploaded this on your portal as well. Okay, so we'll do one of each kind, and the rest of course you have to do at your own time as practice. And in case you have any doubts, any questions, you can always get in touch with either the TAs or me, or bring it to the class. Okay, so that is the thing. But before we begin, any doubts, any questions on whatever we have covered so far? Okay. Another thing which you must remember, Samriddhi will inform us once we have the final groups, but Samriddhi, I think this group presentation we can have on after the minor, because I think minor is from 19th to 23rd. So maybe we can give them a week after minor to prepare. So is 30th a class for them?
Ma'am, let me check.
Just check. Otherwise, just give them a date tentatively after a week of the minor, where we will have presentations of these groups. And basically what you would do is, in your group you will form your own startup idea, and you will imagine that it is at the stage of the startup, just that like the PSA example, and you can take that PSA example as a case study basis, and from there you will tell us how the balance sheet looks like, what the PNL looks like, what the cash flow statement looks like, and what is the COGS and all. So please try and keep your costs and your revenue figures as realistic as possible. Please do a lot of market research before you cite those figures. And naturally, if you have your own startup, then nothing like it. You can cite your own startup's figures. That would be ideal. Okay, that would be best. Fine. So any doubts, any questions so far?
Ma'am?
Yes.
30th is a Thursday. So
Thursday we don't have a class, na? So 30,
yes,
so first October kar le?
Ma'am, I'll ask the class.
Okay, you ask Abhinav, and also how many groups are there? Abhinav, do we have the groups?
Yes, ma'am, we have the groups.
How many groups are there?
Ma'am, currently there are 1, 2, 3, 4, 8 plus 4, 12 groups total now.
12 groups consisting of how many people each?
Ma'am, 4 to 5. Some groups, like 1, 2 groups have like 4 people only, but most of them have 5.
Most of them have 5.
Yes, ma'am.
ठीक है, तो ये तो अगर 5 है तो 60 लोग हुए, फिर what about the other 20?
Ma'am, I mailed this sheet. I think they have not filled it yet.
ठीक है, and you had given them a deadline and all, right?
Yes, ma'am. Yes, ma'am.
And you had also told them that if they don't give their groups का वो, then they will not be considered.
Yes, ma'am.
ठीक है, ठीक है. So just share this list with Samriddhi. And Samriddhi, I think what we can do is we can give 5 to 7 minutes of presentation time to each group, because in the first minute or so, they will first talk about the product idea that they have and the background of the startup. And I'm telling you all this, Samriddhi, so that you can put it in an email and share it with them, so that, because there are only 13 people here.
Yes,
And
ma'am.
then they will use the PSA case study as a example and give us their data. So for their startup, so naturally if they have a real startup, they will give us real data, and if they have a imaginary startup, then they will have to give us imagined data, but the data should be as realistic as possible.
Okay, ma'am.
So they will show us how they have made the production schedule, the COGS schedule, the balance sheet, P&L, how they have projected their revenues, what is a cash flow statement, what does it look like, and of course, when are they reaching their survival revenue, at what point, and all that.
Okay, ma'am.
Okay. So now the numericals that we'll do will also give you an idea as to how you would further compute these aspects. But Samriddhi, just put all of this in an email and share it with them so that all of them know what they have to do. And you can
Sure,
say
ma'am.
that 1st October we will start. But naturally, if there are 12 groups, we may not be able to finish in one class. So we'll then take it over to the next class. Okay.
Ma'am, a total of 55 students have filled the sheet.
ठीक है, तो मतलब 12 ग्रुप्स बने हैं ना, तो 12 सत्ते 84 वैसे तो हो जाना चाहिए एक क्लास में, बट अगर एक दो टीम्स का स्पिल ओवर होएगा समृद्धि, तो वो हम लोग नेक्स्ट क्लास में कर लेंगे.
ओके मैम.
ठीक है, और इनका ना वो भी बता देना ऑर्डर, जिस ऑर्डर में इन लोग प्रेजेंट करेंगे.
श्योर मैम.
एंड इसका आई थिंक 25 मार्क्स का है ना?
यस मैम.
ठीक है, ठीक है. और बाकी का 25 मार्क्स जो इनका टर्म पेपर है वो ग्रुप असाइनमेंट है इनका फिर से?
मैम लेट मी
चेक कर लेना एक बार, ठीक है. So then we will look at how we can extend or what else we can give them as a group. But at least I'll get to see the people. Okay. And Abhinav and Samriddhi, you must emphasize that I want all 5 people to speak.
Okay ma'am.
So they should divide the presentation in such a way कि एक बंदा बैलेंस शीट बता दे, एक P&L बता दे, एक सारे शेड्यूल्स बता दे, एक ब्रेक इवन बता दे, एक कैश फ्लो बता दे, इस तरह करके they should divide the work. Okay?
Okay ma'am.
ठीक. So ये सब डाल देना, हमको भी CC कर देना. और this is what will happen on 1st of October, right?
Yes ma'am, most probably.
ठीक है. Acha, and the other thing was, Abhinav, just for clarification, I hope everybody knows this, that your minor wala jo exam hoga, that will be a time bound exam in the sense that suppose you are given the time ki 11 baje tak ho jana chahiye. So aapko पौने 10 baje we will email the paper to you, and आप 10 से 11 उसको solve करिएगा, and 15 minutes extra you will be given to mail it to us. So we will be sharing our mail ID, so you will be required to mail it to us. Okay?
Okay.
And it will all be done in a Word document. तो हम उसी Word document में marks देकर and then वापस I will be able to share it with all of you. So इस तरह से होगा. So please inform everyone that this is how it will be the minor paper. And Samriddhi, you can also put it in the email.
Okay ma'am.
Do we have the exam schedule out yet?
Not yet ma'am.
Okay, okay, fine. So when it's out, then we'll inform. ठीक है. So are there any other doubts, any other questions? Okay. So now I'm going to share my screen. I'm going to shut down my video so that some space is left. And we are, okay, I'm not going to take it from here. Let us go through this. Okay. Samriddhi, is this visible?
Yes ma'am.
Okay, fine. So let us look at a numerical for estimating sales growth rates and then the subsequent sales and profits. Now this is a new startup called Petal Providers Corporation. It opens and operates mega florist stores in the US. The idea behind the superstore concept is to model the US floral industry after its European counterparts, whose flower markets generally have larger selections at lower prices. Revenues were $1 million with net profit of $50,000 last year. Am I audible, Samriddhi?
Yes ma'am, you are.
Okay, because it is giving me a message called bad network quality and also that's okay. Okay, fine.
Okay.
Let me know in case of any issue, okay? Fine. So revenue for petal providers were $1 million with a net profit of $50,000 last year when the first petal provider's floral outlet was opened. If the economy grows rapidly next year, petal providers expects its sales to grow by 50%. However, if the economy exhibits average growth, petal providers expects a sales growth of 30%. And for a slow economic growth scenario, sales are expected to grow next year at a rate of 30%. Management estimates the probability of each scenario occurring to be rapid growth 30%, average growth 50%, and slow growth 20%. Petal providers' net profit margins are also expected to vary with the level of economic activity next year. If slow growth occurs, the net profit margin is expected to be 5%. Net profit margins of 7% and 10% are expected for the average and rapid growth scenarios respectively. So based on all this data and the scenarios and everything, please estimate the average sales growth rate for petal providers for next year and estimate the dollar amount of sales expected next year under each scenario as well as the expected value of sales amount. Okay. So how do you want to do it, students? Should I give you some time to solve this and then show you the solution, or do you want to go to the solution first? Abhinav, how would you like this to be solved?
Ma'am, currently I can't see your screen. It's completely black.
No, that's because I've opened up the window, na? That is why. Because
No,
I'm
ma'am.
talking to you.
Ma'am, यहाँ पे हॉस्टल नेट नहीं आ रहा है right now currently.
अच्छा, तो तुम लोग ऐसा करो ना, तुम लोग टीम्स पे जो फाइल है ना उसमें से उसको डाउनलोड कर लो.
Okay.
हमने अपलोड करा हुआ है. अगर तुम लोग को स्क्रीन नहीं दिख रही मेरी, जैसे नेट का कुछ इशू हो रहा है, तो अपने उस पे डाउनलोड कर लो. वहां पे अपलोडेड मिला है ना मटेरियल. What I was asking you guys is that should I give you time so that you can solve these numericals and then we can go through the solution, or do you want me to discuss the solution with you? How do you want me to proceed?
Ma'am, a little bit
Ma'am,
of time.
for the first question, I guess you can discuss the question right now itself, and from next questions we will. It would be better if you can give us some time to solve.
अच्छा ठीक है. For similar questions, मतलब you're saying, Alia?
Yes, ma'am, exactly.
ठीक है. Okay, Alia. Okay. ठीक है. So if this is the data that is given and you have to calculate the sales growth, and then based on that you are supposed to calculate the dollar amount of sales as well as the expected the value of sales amount. So this is the solution. Just let me show you. All of this is already there. So Samriddhi, is this visible?
Yes, ma'am.
Okay, great. So here you can see the details are already given. The previous year's revenue were $1 million and the previous year's net profit was $50,000. We already know from the PSA case study that we can have three economic scenarios: rapid economy, average growth, and slow growth. The sales growth rates are given for the three as 50%, 30%, and 10% respectively. Similarly, we are also given the net profit margin rates for the three scenarios as 10%, 7%, and 5%. And the probability of occurrence of the three scenarios are 0.3 for rapid, 0.5 for average, and 0.2 for slow growth rate. So all you need to do over here, first you have to calculate the average sales growth rate. So for each scenario, we multiply the sales growth rate with the probability of occurrence to get the sum, that is 15%. For average growth, we multiply 30% with the probability of occurrence. which gives us 15%. And for slow growth, we multiply the sales growth rate with the probability of occurrence, which is 0.2, which gives us 2%. So when we add all of these three scenarios growth rates, we get the average sales growth rate as 32%. Okay. So based on this, if we have to calculate the average sales amount, okay, then we can see. So if in the rapid economy the sales growth was 50%, then the forecasted sales amount would have been 1.5 million. And in the average growth, if it was 30%, then it would be 1.3 million. And for slow growth at 10% from the previous year, it would be 1.1 million. Again, the probability of occurrence for the three are given. And when we multiply the forecasted sales amount with the probability of occurrence, we get the naturalized sum. And so the expected sales amount would be $450,000 for the rapid economy, $650,000 in the average growth economy, and $220,000 in the slow growth economy, which gives us the expected sales amount at 1.32 million. Okay. Similarly, we can also calculate the net profit. Now, all of you know that net profit margin is nothing but net profit upon sales. So, if in the rapid economy, the net profit is going to be 10%, then it is going to be 10% of 1.5 million, which is $150,000. And the probability of occurrence is 0.3. So, the net amount will be 45,000. Similarly, in the average growth rate, it is 7% of 1.3 million. That gives us 91,000. This into the probability of occurrence gives us a sum of 45,500. And at the slow growth, we have 5% net profit margin. And then we have the forecasted sales amount at 1.1 million. So this gives us the net profit of 55,000, which when multiplied with the probability of occurrence of 0.2 gives us $11,000. Okay. So the total net profit amount that is expected is $101,500. इस तरह calculate करना है. It is very simple. You already have the basic skeletal framework in that case study. You just have to apply these figures to that framework and you will get the amounts. Any doubts, any questions, please ask. Okay, now let me go to the second numerical. This one is fine. Just a second. किसी को कोई भी doubts हो, questions हो, तो please ask. Okay. Okay, fine. Now this is the second. Just a second example. Samriti, I hope that it is visible. Alia, is it visible?
Yes, ma'am.
Yes, ma'am, it is.
I couldn't hear Samriti, so. Okay, now the second question is again on sustainable sales growth rate. So here maybe I can give you guys some time to try and solve it. Now, Petal Providers Corporation, described in problem 1, is interested in estimating its sustainable sales growth rate. Last year, the revenues were $1 million. The net profit was $50,000. The investment in assets was $750,000. Payables and accruals were $100,000. And stockholders' equity at the end of the year was $450,000. That is beginning of the year equity of $400,000 plus the retained profits of $50,000. The venture did not pay out any dividends and does not expect to pay dividends for the foreseeable future. Estimate the sustainable sales growth rate for Petal Providers based on the information provided in this problem. And how would your answer to part A change if economic growth is average and Petal Providers net profit margin is 7%? So can you solve this, or are you confused as to how we should adopt this? Alia? Anyone?
Ma'am, this seems like
a little confusing. Achha,
yes, ma'am.
So let me show you the also, and then maybe you can do this Minoso Corporation wala example. Okay, just a second. Okay. Now please understand this. The retained earnings have been 50,000 and the total equity now, because of the initial equity of 400,000 and the retained earnings of 50,000, is $450,000. The net income, all of you know, is 50,000 and the sales is $1 million. Okay. So सबसे पहले we have to calculate the sustainable growth rate. Okay. So how do you calculate the sustainable growth rate when the dividends and all the information is given to you? First, we calculate what is called retention ratio. Retention ratio is nothing but, students, the amount of money which has been retained back into the business. Now, typically for a startup, it will always be 100% because the startup is always short on funds. So whatever little money they can make out of their operations is immediately plowed back into the business. So typically for all your questions, it will be 1. Okay, so since no dividends are paid, entire profit is retained. Therefore, the retention ratio is 1. Okay. Then the second step is the calculation of return on equity, which is the return that you are expecting. Okay. So return on equity is basically the net profit that the company makes based on the year, the beginning year equity. That was the initial investment that the shareholders had made. So we have made 50,000 profit and we have 400,000 as the initial equity. So we have a ROE of 12.5%. Now this is a very simple way of estimating the return on investment for your actual promoters. Third step into how we calculate the sustainable growth rate is nothing but retention ratio into the return on equity. So our retention ratio has been 1 and the return on equity is 12.5%. So we can very easily say that the company will grow at 12.5% in the future as well, because that is the growth that has been shown in the previous year. Okay, from the previous year. So this is how we calculate sustainable growth rate based on the retention ratio as well as the return on equity. So अगर आपके पास ये data दिया हुआ है, then this is how you will calculate the sustainable growth rate. Now, the company is wanting to ask what happens to the sustainable growth rate in case, let me just go back to the numerical. How would your answer to part A change if economic growth is average and petal provider's net profit margin is actually 7%? Then how will your answer change? Okay, so let us see. First step, again, we calculate the retention ratio, which remains at 100%. So it is 1. The net income in case of average growth rate. So we know that average growth rate mein hamari net income calculated from the previous example is $91,000. Okay. So we have taken the same amount from the previous data. This is it. So the new sustainable growth rate will be calculation of retention ratio, which remains at 1, and we have calculation for return on equity. Now we know that the net income which will come in the case of average growth rate is 91,000. So the ROE will now be 91,000 divided by 400,000. So the ROE will now become 22.75%. Okay, 22.75%. And then the new sustainable growth rate will be nothing but the retention ratio into return on equity, which is 1 into 22.75, that is 22.75%. Okay, so this is how we calculate sustainable growth rate if we are given the amount of retentions and the return on equity data. Okay, so this is another way of calculating your sustainable growth rate. Now let us look at the third numerical. This is very important, students, very important. Let me just maximize this. Additional funds needed, or AFN. Okay, additional funds needed, very important concept. Petal Providers Corporation, the same company described in problem 1, is interested in estimating its additional financing needed to support a rapid increase in sales next year. Last year, revenues were 1 million, net profit was $50,000, investment in assets was $750,000, payables and accruals were $100,000, and stockholders' equity at the end of the year was $450,000. The same data that has already been given in question number 2 as well. The venture did not pay out any dividends and does not expect to pay dividends for the foreseeable future. What would be your estimate of the additional funds needed next year to support a 30% increase in sales? And how would your answer in part A change if the expected sales growth were only 15%? So over here, we are trying to look at what would be the additional financing required by petal providers if we support a 30% growth in sales and if we project a 15% growth in sales. Okay, so let me show you the numerical, solution to this, as well as the formula that we use for AFN, and then maybe question number 4 you will be able to solve, because it will have both sustainable sales growth rates and additional funds needed. Okay, so let me come here. So this is all of the information that has already been given. Previous year's revenues were 1 million. Previous year's net profit was 50,000. Total assets that has been invested is 750,000. Payables and accruals are 100,000. Retained earnings, you know, is 50,000. And the profit margin right now, if you look at the profit upon the sales, is 5%. Okay. So now we want to understand how much of additional funds would be required. Yes?
I guess the screen is not visible.
Screen is not visible. Just a second. Why is it not visible? Is it visible now?
Yes, ma'am.
Okay, great. So I was just rattling out the data that is already given in the question, and it has been repopulated here so that, you know, in the solution you have the complete thing. Now what we need to calculate is the additional funds required when the increase in sales is 30%. Okay, so that means everything, when we have to increase sales by 30%, then of course we will increase our assets by 30% also to increase our sales. Okay. So this is the formula that is used to calculate AFN, or additional funds needed. Very important concept for any startup, students. This is not given in normal management accounting or financial management. It is only unique to new startups. So please remember this formula and you should apply it to your startup as well. It is increase in assets. That is, how much of assets will we need to increase? How much of financing will we need to basically expand our assets to support the kind of growth that we are looking at? Minus increase in spontaneous liabilities. This means that if we are able to raise some part of our working capital that is required through current liabilities, through payables, through accruals, then that is basically external money helping us. So we can reduce this amount. Plus, where else do we get funding? We get funding from our own profits that we are making, our own income from our operations. So in case we are retaining that, then this also we can reduce, and whatever is remaining is the additional funds that is required. Okay. So all you need to do is calculate these 3 steps. First step is calculate increase in assets. We know that assets are 750,000. So if there is a 30% increase, then we need $225,000 more to finance these assets. The second step is there any increase in liabilities? So if we are able to increase our liabilities by $100,000 by 30%, then 30,000 rupees comes from our increased liabilities. And the third step is we see what is the increase in retained earnings. So the new sales is now expected to be 1.3 million. And the net profit is net profit margin into new sales. So that is 5%. So that is 65,000. Again, because it's a startup, we are expecting to retain all of this. So we will retain all of the $65,000 into our business. So what is the net amount required? That is additional funds needed. It is nothing but the amount required for increase in assets minus the increase in liabilities minus the increase in retained earnings. So we have already calculated this. So it is $225,000 minus $30,000 minus $65,000. And so the additional funds needed by the company is $130,000. Similarly, if we have to calculate it for 15% growth, then 15% growth पे आपके increase in assets would be 750,000 into 15%, which is $112,500. Then increase in liabilities at 15% will give us $15,000. Then we have to look at increase in retained earnings. Now the new sales will be 1.15 million. The net profit will be 5% of this. We are retaining 100%. That means retentions are giving us 57,500 from our own operations. So the additional funds needed would be 1.125 million minus 15,000 minus 57,500, which gives us $40,000. So when you are calculating your growth rates, and then when you will see at every year when you will be increasing your sales, how much of additional funds you will be requiring, and this is what you would be asking your investors. Okay, to fund this kind of growth rate, our operations will generate this much, our liabilities will generate this much, but still we will have a shortfall, and so we are requiring additional financing for this. Okay, so you have all of this material. Now try and solve question number 4. Let me read it out to you. Try and solve it. It has both these components. It has both sustainable sales growth rates as well as the additional funds needed. Okay, just let me see. I think the data is, yeah. So I am expanding this. You can download it onto your own systems as well. You have to calculate both sustainable sales growth rates and additional funds needed for the Minoso Corporation, which anticipates a 20% increase in sales for 2017 over its 2016 level. Minoso is currently operating at full capacity and thus expects to increase its investment in both current and fixed assets in order to support the increase in forecasted sales. Now you are given the income statement. So you have sales, you have operating expenses. Just a second. Okay. Then you have their EBIT of $2,000. Then you have interest of $400. So you get EBT of $1,600. Taxes are levied at $640. So you get a net income of $960. And then you are also giving out cash dividends. So the new thing that is happening here is that you don't have 100% retention, but you have 60% retention. So you're giving cash dividends of $384 and you have retained earnings left of $576. Samriddhi, can you hear me?
Yes, ma'am.
ठीक है. So Samriddhi, कुछ बोलना होगा तो मैं तो ऐसे बोल देना, because I don't have my phone with me. Okay.
Okay, ma'am.
Then if you see their balance sheet, it is given like this. They have cash of $1,000. They have accounts receivables of 2,000. They have inventories of 2,200. So their total current assets are 5,200 and their fixed assets net are 6,800. So they give total assets of 12,000. And then they have accounts payable of 1,600. They have a bank loan of 1,800. They have other accrued liabilities of 1,200, which gives a total current liability of 4,600. Then they have long-term debt of 2,200. They have common stock, which was the initial equity of 2,400, and they have retentions of 2,800. So this gives us a total liability in equity of $12,000. So based on this, estimate Minoso's sustainable sales growth rate based on the financial data relationships for 2016. In making your estimate, calculate each component of the firm's operating performance and financial policies. And then second, you have to estimate the additional funds needed for 2017 using the formula or equation method. So please, we have already done numericals on this, so try and attempt this. How much time should I give you before we can start discussing? Will 5 minutes be okay, or do you want some more time? Abhinav?
Yes, ma'am.
Will 5 minutes be okay to try and solve this, or should I give you extra time, more time?
We can try.
ठीक है, try करो. Everyone, please try. And if anyone is facing any kind of issues, you can please ask. I would request everyone to try. Yes, Abhinav?
Can you minimize this window?
Yeah, I will. Okay. Abhinav, it is already uploaded on your Teams as well. Okay, if you can't see it here, you can just download it from there.
Okay, ma'am.
Let me see if everyone is doing it. I can't see everyone unless I minimize this. Is everyone solving? Alia, are you there? Ratnesh, are you trying to solve?
Ma'am, I had some internet connectivity issues. Where is this question? I couldn't see.
It is there on your files also, and it is there on your screen also.
Yeah, it is visible right now, but it is not visible. Okay.
यहीं से ले लो डेटा. अच्छा, हमको ये बताओ कि इसमें कौन सा सस्टेनेबल सेल्स ग्रोथ वाला फॉर्मूला लगेगा? वो सिनेरियो वाला लगेगा कि रिटेंशन वाला लगेगा? कोई नहीं कुछ बोल रहा है. The moment anyone gets the answer, na, please tell me, okay? In case anyone is facing any questions or doubts, please ask. Unfortunately, we don't have a proper classroom scenario where we can actually see you solving these, so I have to trust that you are doing it. Anyone who has been able to get any figure? Okay, take 2 more minutes and then we can discuss. Okay, anyone? Okay, Abhinav, I have now increased the screen because I wanted to see all of you. So I don't see Abhinav here only. Okay, Ratnesh, did you try?
Yes, ma'am, I tried, but I didn't get it.
You didn't get anything? मतलब कुछ भी किया आपने solve? Sustainable sales growth वाला किया? कि you were just waiting कि 5 minutes हो जाए फिर मैम बता देंगी कैसे करना है. Karthik, what about you? Divya, what about you? Divya तो चली गई, भाग गई. Hitesh, what about you? Pawan, Pritesh, Ronit, Razi and Surendra. Any one of you, Ronit? What about you?
Yes, ma'am. Ma'am, I tried to do it.
हाँ, क्या क्या किया तुमने बताओ, स्टेप बताओ क्या किया?
Ma'am, I was trying to do additional funds needed part.
हाँ, तो क्या किया तुमने उसमें?
Ma'am, first of all, I used that formula, but actually I wasn't able to memorize it at that time. So I first of all, I multiplied the additional sales which we need in the 2017 year. That is 20% increase in sales. So I multiplied it by the assets.
Multiplied the sales by the assets.
Oh yes.
गड़बड़ कर दिया रोनित, तुमने फॉर्मूला ही वो करा. अच्छा ठीक है, लेट मी let me take you through the solution one by one, and then you can see where exactly you made the mistake, and now you can remember it. Okay. And the other person, Razi, I think has left. Yeah, I think it is becoming a waste of time, or what, Samriddhi, to give them 5 to 7 minutes to solve it.
Yes, ma'am.
Because I think Ronit को छोड़ के किसी और ने उसको solve करने की कोशिश भी नहीं की है. So anyway, let me share the solution. Because this way we keep waiting for everyone, then we are just wasting time. Just a second. Okay, now Ronit, look at this. We have all of this data that has been given to us. We have net income of 960,000. We have common stock of 2,400,000. We have retained earnings of 2,800,000. We have cash dividends at the rate of 40% of 384. And so we are retaining only 576 or 60%. Net sales is given as $15,000 and total assets are 12,000. Okay. So beginning year's equity, if we have to understand how much of equity we had in the beginning, it is basically the common stock that we had plus the retained earnings minus the retained earnings of 2016. Okay. So which basically gives us the common stock of 2,400 plus the retained earnings of 2,800 minus the retained earnings of 2016, which is 576. So when we subtract this, then we get 4624 as your original beginning year equity. Okay. Now first we have to calculate the sustainable growth rate. So for that we need to calculate first the retention ratio. Now all of you know that 40% has been paid off as dividends. So it is common sense that the retention ratio is 0.6. Okay, which is nothing but 1 minus the payout ratio of 0.4. Then the second is to calculate the return on equity. Now all of us have the figure of net income given to us at 960. And the beginning equity is given to us as 4624. So the return on equity is 20.76%. Okay. We can also calculate this return on equity by this ratio, but that's okay. You can apply this also if you want, but otherwise the main thing is net income upon beginning equity. Okay. Otherwise, the other formula used for calculating return on equity is your net profit margin into asset turnover into equity multiplier, which is nothing but net profit margin is net profit upon net sales, asset turnover is net sales upon total assets, and equity multiplier is total assets upon beginning equity. So if you see again over here, net sales and net sales will cancel out. Total assets and total assets will cancel out. So we will get eventually net profit upon beginning equity. Okay. So the third step is the calculation of the sustainable growth rate, which is nothing but retention ratio into return on equity. So that is 0.6 into 20.76. That is 12.46. Okay. So this is how you calculate the sustainable growth rate. Now the second part of the question was to calculate the additional funds needed in 2017. So let us look at the data given to us again. We have previous year's revenue of 15,000. Then we have previous year's net profit of 960. We have total assets given of 12,000. And it is given in the question that all assets would need to be increased. Okay, both current assets and fixed assets. Then we have account payables of 1,600. We have accrued liabilities of 1,200. And we have retentions of 50,000. The profit margin, if you calculate from here, is 6.4%. And we need an increase in sales of 20%. Okay. So Ronit, here look at the formula. It's very simple. Additional funds needed is increase in assets minus increase in spontaneous liabilities minus increase in retained earnings. So for increase in assets, we multiply the total assets of 12,000 by 20%, we get 2,400. For increase in spontaneous liabilities, we just look at the account payables plus all our accrued liabilities, which adds up to 2,800. We take 20% of this, it gives us 560. The third step is to calculate the increase in retained earnings. So we know that the new sales will now be 18,000 because we're expecting a 20% increase. The new profit will be new profit margin into new sales, the net profit margin into new sales, which is 1152. The retention ratio we know is 0.6. So the retained earnings that we'll get is 691.2. So what would be the additional funds needed? Additional funds needed would be 2400 minus 560 minus 691.2, and that is 1148.8. Okay, so this is again step by step how you will calculate both sustainable growth rates as well as the additional funds needed. Okay, so now let us look at the next numerical. Yes, Ronit.
What do you mean by spontaneous liabilities?
Spontaneous liabilities, as the name suggests, ये spontaneously exist करेंगी when you run your operation. So Ronit, when you're running a factory, then liabilities are occurring in the normal course of business because of your buying material and other things from your suppliers. So spontaneous means it occurs in the natural course of business. You don't have to do anything specific to increase that liability. मतलब आपको बैंक से जाके कोई लोन नहीं लेना पड़ रहा है, ये आपके नॉर्मल बिजनेस से स्पॉन्टेनियसली जनरेट होएगी. ओके रोनित? So spontaneous liabilities are always related to your main operations. जो आपके operations चल रहे हैं, जिसमें आप खरीद रहे हैं सामान, उस पे क्रेडिट पे कर रहे हैं, ये रोजमर्रा का काम है. This is happening on a day-to-day basis. So these are called spontaneous liabilities. Non-spontaneous would be when you actually go and take a loan from someone or a bank or something, and you're creating a liability per se, alag se. But this is happening because of your business operations. Okay, Ronit?
Okay, ma'am. Thank you.
Okay. And Ronit, I hope that now you were able to see the basic formula and how simple it was.
Yes, ma'am. Yes, ma'am.
Very good. Anyone else? Arka, Kartik, Hitesh, Pawan, Pritesh, Ratnesh, और कौन है? Anyone else who had any doubts? Any और कोई है नहीं? Okay, let me go to the next numerical. Okay, now this again I would expect you to solve on your own only, because it is also the same thing. Sustainable sales growth rates and additional funds needed, and here you are given 2 years data, and then you are given all of this. So I think you can solve this on your own. Once you solve it, then you look at the solution to see whether the steps that you have followed are fine or not. Plus, please do everything in a step-by-step way. We have given you the correct format. Please follow that only. Okay. Unfortunately, you will not find any book where you will have these startup related questions solved for you. So we have created a question bank for you so that you can solve these. And also the kind of questions that we'll ask you during the exam would also be similar to the ones that are given here. Okay, so this is for that. Now let me come here. Okay, now we are going to look at some numericals on how we prepare and use financial statements. Okay, so here also some new aspects we will understand. Samriddhi, is this visible?
Yes, ma'am.
Yes. Okay, great. So first question is based on stockholders' equity, that is the owner's equity. The owners of a new venture have decided to organize as a company. The initial equity investment is valued at $100,000, reflecting contributions of the entrepreneur and her family and friends. 100,000 shares of stock were initially issued. What dollar amount would initially be recorded in the common stock account? And B, if a par value on the common stock was set at $0.01 per share or 1 cent per share, show how the initial equity investment would be recorded. Okay, so let us see how this would be solved. So just a second. Okay. Okay. Now initial investment that has been made is 100,000, and the number of stocks issued are 100,000. That means each stock is valued at $1. So the initial amount will be recorded as 100,000 only. Okay, so this is very simple. Now suppose that the par value or the face value, that was the first initial value of the stock, was recorded at only 1 cent. Then that means that the company had actually called for only 1 cent per per share, and the number of shares that were issued. So the main money that had come in terms of common stock was the number of stocks issued into the par value. So number of stocks issued are 100,000 into 1 cent or 0.01 gives us common stock value of 1,000. And this means that this $99,000 has been the premium that has been paid for this company, or the additional funds that have been paid for this company. Okay, so this is shown in a separate reserve, which is called additional paid in capital, or it is also called share premium reserve, and the balance amount is put over here. So this is 99,000. The total equity anyway will remain $100,000. Okay, so this is how basically the par value changing will bring will create two sub accounts. One would be the actual stock value, and the other would be any premium that has come into the company. Okay, then let us look at part C, what it is asking. Okay, let me close this. Let me close this as well. Okay. Now, assume that 20,000 additional shares of stock are sold to an angel investor at $5 per share 6 months after the initial incorporation. Show how your answer in part A would change if the common stock did not have a par value. Also show how your answer in part B would change given a par value of 1 cent per share. So basically what has happened is, after 6 months you have also taken on an angel investor and you have given him 20,000 additional shares at $5 per share. Okay. Then the fourth part, at the end of the first year of operation, the venture recorded an operating loss of $80,000. Show the dollar amount.
Hello? Ma'am, you're not audible.
Am I audible, Samriddhi?
Ma'am, now you are.
Okay, fine. I think there was some network issue or something because of which suddenly, but I could hear all of you and I could see all of you, so I don't know what went wrong. Okay, so till when was I audible, Samriddhi?
Ma'am, you were just discussing the question. You had just started discussing the question.
Okay, fine. Okay, just a second. Fine, so let me go back to the question. So there were C and D figures. Could you hear me when I was reading out the question?
Yes, ma'am.
Okay, fine. So let us look at the solution now. Now, in part C, what we have done is we have sold additional shares to an angel investor, and we have basically given him 20,000 shares at $5 per share, which has given us a deal value of $100,000. So now in case of part A, we had the initial investment of 100,000 plus we have the additional investment of 100,000. So now we have a total equity of $200,000. And when we have a par value that is set, then we have common stock equal to $120,000, which is the total number of shares into 0.1, which is the face value. So that becomes 1,200, and everything else of $200,000 comes to us as additional paid-in capital. Okay.
Ma'am,
Yes.
nothing is visible. Your screen is not visible. Perhaps, I think.
Just a second. Is it visible now?
Yes, ma'am.
Yes, yes.
Okay, okay. So I will show you again. I was reading out, but when we are selling out additional shares of 20,000 at the rate of 5 rupees per share to an angel investor, this means the total money that has come in is 100,000. And the initial investment was 100,000, and the additional investment that has come in now is another 100. So our total equity now becomes $200,000. But if we have to show this equity in terms of par value and in terms of the additional paid-in capital, then the common stock is $120,000 into 0.01, that is 1,200, and the additional paid-in capital will now be 198,800, which is basically the balance amount of the $200,000. Now over here, if we are recording the loss of $80,000 in the fourth example, then we have common stock as it is of 1,200. We have additional paid-in capital of 198,800 minus retained earnings of 80,000. So that means that in our total equity, basically our equity has been eroded due to the loss of 80,000. So our total equity value will now remain only $120,000. So just as profits actually increase our equity value, similarly the owners have to bear the loss, and that erodes their ownership value. Okay, so this is how we calculate this. Any doubts, any questions, please ask. Okay, let us look at the second question, which is basically on internal operating schedules. And based on this, then you can do question number 3 and 4 on your own. Okay. Assume you are starting a new business involving the manufacture and sale of a new product. Okay. Raw material costs are $40 per product. Direct labor costs are expected to be $30 per product. You are expected to sell each product for $110. You plan to produce 100 products next month and expect to sell 90 products. So part A, prepare cost of production, cost of goods sold and inventory schedules for the next month. And during the second month, you plan to produce 110 products but expect sales in the month to be 115 products. Prepare cost of production, cost of goods sold and inventory schedules for the second month. So basically 2 महीने के लिए आपको prepare करना है. So let us see how this is done. Okay. Now, this has already been given to us, the data. We have been given that raw material is $40 per unit, direct labor is $30 per unit, and the sale price is $110 per unit. And we are also given the data of production and sale. So in the first month, we are producing 100 units and we are selling 90. And in the second month, we are producing 110 and we are selling 115. So based on this data, first we will calculate or present the cost of production schedule. So for 2 months, we have to calculate first month and second month. So production units have been 100 in first month and 110 in the second month. Production cost is divided into raw material and direct labor. So raw material cost is 40 per unit and labor is 30 per unit, giving us a total of 70 per unit. So material cost becomes 40 into 100, that is 4,000 for first month. and 40 into 110, that is 4400 for second month. Labor becomes 30 into 100, which is 3000 for first month, and 30 into 110, which is 3300 for the second month. So this gives us a total cost of 7400 units in the first month and 7700 for 110 units in the second month. Then we have to prepare the COGS schedule, that is how much did we sell. So in the first month we sold 90 units at the cost of 70 per unit. It was 6300 rupees, and $6,300. And in the second month we sold 115 at the cost of 70 per unit. It was 8050. Okay. Then the inventory schedule, if we have to calculate, in the first month we did not have any opening inventory. We made 7000 worth of inventory. Okay, less how much did we sell? 6300. So we have a closing inventory of 700 at the end of the first month. This became the opening inventory for the beginning of the second month. To this we added 7700 worth of production. So we had a total inventory of 8400 minus the cost of goods sold, which is 8050. So we have a closing inventory level of 350. Okay, so this is how basically your operating schedules are calculated. Very, very simple, nothing not too difficult to understand at all. Very simple. So I'm sure that question number 2 and 3 you should be able to solve on your own based on this, even 4. Okay, so do you want me to give you time, or do you want me to go through the other numericals? Tell me, class.
Ma'am, we can go through the other numericals, I guess.
Okay, but then Ronit, all of you must promise me that you will solve these, as homework, and you will see कि कहीं पे आप अटक तो नहीं रहे, कहीं पे कोई problem तो नहीं हो रही है, solutions आपके पास already दिए हुए हैं, but still you will solve it. Okay?
Sure, ma'am.
Okay, thanks.
Okay, ma'am.
Okay, thanks. Okay, so now let us look at the 5th question, which is basically on calculating survival revenues break even. So let me increase this a little bit. Okay, yeah. Now, during the first year of operations, the sub-Ray Corporation produced the following income statement results. So this is their income statement. Net sales they had of $300,000 minus cost of goods sold of 180,000. So gross profit became 120,000. From this, we deducted the general and admin expenses and marketing expenses of $60,000 each. And depreciation of 20,000, which gave us an EBIT of minus 20,000. So it's loss making. Then we also reduced the interest expenses of 10,000. So we got the EBT of $30,000. Naturally, because the company is making a loss, we have not deducted any taxes here, and we get net earnings or loss of minus $30,000. Now, cost of goods sold are expected to vary with sales and be a constant percentage of sales. The general and admin employees have been hired and are expected to remain a fixed cost. Okay, then some part of this question is on the next page, so I'm going to take you there. Just a second. Okay, no, I think this is earlier. Yeah. Okay. Then these expenses are also expected to remain fixed because the current sales staff members are expected to remain on fixed salaries and no new hires are being planned. The effective tax rate is expected to be 30% for a profitable firm. Based on this, estimate the survival or EBITDA break-even amount in terms of survival revenues necessary for the sub-Ray Corporation to break even next year. And B, assume that the product selling price is $50 per unit. Calculate the EBITDA break-even point in terms of the number of units that will have to be sold next year. Okay, so let us see how this is done. Okay, so you have the solutions to the other questions given here also, but please solve it first and then only look at this, otherwise there'll be no. Okay, so this is the solution to this current question of Sabre. We are given the following information. We are given COGS of 180,000. We are given the cash fixed cost of general and admin expenses of 60,000, marketing expenses of 60,000, and the financial fixed cost of 10,000, which gives us a total cash fixed cost of $130,000. Okay, and the net sales we are given as 300,000. So we know that the variable cost to revenue ratio, or VCRR, is 0.6. Okay, that is COGS of 180,000 on a sales of 300,000. Then we just have to apply all these values into the formula. You know that survival revenue is nothing but cash fixed cost divided by variable cost to revenue ratio. So it is nothing but 130,000 divided by 1 minus 0.6, which is $325,000. Now, how do you check whether this calculation is correct or not? You just do a reverse calculation of the P&L. So you start with survival revenue of 325,000 minus COGS at the rate of 60% will be 195,000, which will give us a gross profit of 130,000. From this, you take out the fixed cost of general and admin expenses, marketing expenses, and interest. You will get 0. This shows that we have calculated it correctly. And what would be the break even in number of units sold? It will be nothing but the total revenues minus divided by the selling price per unit. That will give us the number of units. So we are given that 50 is the selling price. So we divide 325,000 by 50 and we get 6,500 products to be sold to be able to break even. Okay, so very simple, all formula based questions, students, so it's nothing very difficult for you. Okay, next question. Fine, this is also a new type of question, so we can see this. Statement of cash flows and cash burn or build, very important. Now, Cindy and Robert Castillo founded the Castillo Products Company in 2015. The company manufactures components for personal decision assistance products and for other handheld electronic products. Year 2015 proved to be a test of the Castillo Product Company's ability to survive. However, sales increased rapidly in 2016 and the firm reported a net income after taxes of $75,000. Depreciation expenses were $40,000 in 2016. Following are the Castillo Products Company's balance sheet for 2015 and 2016. So, 2 साल की balance sheet दी हुई है. Cash in 2015 was $50,000 and $20,000 in 2016. Accounts receivables were $200,000 in 2015 and $280,000 in 2016. Inventories were $400,000 in 2015 and $500,000 in 2016, which gives us a total current assets of $650,000 in 2015 and $800,000 in 2016. The gross fixed assets in 2015 were $450,000 minus the accumulated depreciation of $100,000, which gave us the net fixed assets of $350,000. This brought the total assets amount to be $1 million. Similarly, in 2016, we had gross fixed assets of $540,000 less accumulated depreciation of $140,000, which gave us the net fixed assets of $400,000 and the total assets value of $1.2 million. The corresponding liability side of the balance sheet shows accounts payables of $130,000 in 2015, accruals of $50,000, bank loans of $90,000, giving us a total current liability of $270,000. Similarly, long-term debt was at $300,000. Common stock, which was given at 0.01 par, was $150,000. Additional paid-in capital was $200,000, and the retentions were $80,000, bringing the total back to $1 million. And for 2016, we can see that the accounts payable were $160,000, accruals was $70,000, bank loan was $100,000, bringing us to a total of current liabilities of $330,000. And then when we look at the long-term liability, we have long-term debt of $400,000, common stock at $150,000, additional paid-in capital of $200,000, retained earnings at $120,000, which brings us to a total of 1.2 million. Now, all this data is given to you. Based on this, calculate Castillo's cash flow from operating activities for 2016. Calculate Castillo's cash flow from investing activities for 2016. Calculate Castillo's cash flows from financing activities for 2016. So basically calculate all the cash flows. Then prepare a formal statement of cash flows for 2016 and identify the major cash inflows and outflows that were generated by the Castillo Products Company. Use your calculation results from parts A and B to determine whether Castillo was building cash or burning cash during 2016 and indicate the dollar amount of the cash build or burn. F, if Castillo had a net cash burn from operating and investment activities in 2016, divide the amount of burn by 12 to calculate an average monthly burn amount. If the 2017 monthly cash burn continues at the 2016 rate, indicate how long in months it will be before the firm runs out of cash if there are no changes in financing activity. So this is a very, very comprehensive question. It first asks us to calculate all three cash flows, then prepare a formal cash flow statement, then calculate whether there's a cash build or burn, and then also calculate the cash burn or build rate. Okay, and accordingly tell us as to how many months does the company has before it actually runs out of cash. Okay, so let us see the solution for this. Okay, now we have been given all this information. Net income after taxes is 75,000 and the depreciation is 40,000. So let us start first with the cash flow from operating activities. Now in cash flow from operating activities, we always start first with the net profit, which is 75,000. Plus we add back depreciation because that is not a cash outflow. It is there with us. Less, if you remember the formula, less increase in receivables. So we can see an increase in receivables over the over 2015 of 80,000. So we are subtracting that. Less increase in inventories of 100,000. So we are subtracting that. Plus increase in accounts payable. So there's an increase of 30,000. So we are adding that. Plus increase in accruals, that is been of 20,000. So we are adding that. So still the net cash flow from operations is minus $15,000. Okay. Then the second is cash flow from investing activities. So basically we have seen that we have added gross equipment worth 90,000. So that means the company has spent this cash. So that is also giving us a negative cash flow of $90,000. Okay. Then we look at the cash flow from financing activities. So we have an increase in bank loan over 2015 of 10,000. So that is where money has come in. Plus we have an increase in long-term debt also. So that is 100,000. Minus we have paid dividends of 35,000. So how has dividend amount arrived? And that is because increment in retained earnings is 40,000, which is less than the reported net income of 75,000. Hence, it is assumed that the rest of the amount is distributed as dividends. So, matlab, aapka 75,000 was your net income, but you have only retained 40,000. That means that the other 35,000 you have paid out as dividends. Okay. So, we are reducing that and we have net cash flow from financing activities at 75,000. Based on all of these three separately drawn, we can now make the formal cash flow, which is nothing but a summarization. So cash flow from operating activities, we start with net income, add depreciation, less increase in receivables, less increase in inventories, plus increase in accounts payables, plus increase in accruals, giving us net cash from operations of minus 15,000. Then the second is cash flow from investing activities, which is increase in gross equipment of 90,000. So that gives us a cash flow from investing activities at minus 90,000. So it is evident that the company is burning cash. Okay. Then the third part is cash flow from financing activities. We have increase in bank loan of 10,000. We have increase in long-term debt of 100,000, and we have dividends paid of 35,000, which gives cash flow from financing activities of 75,000. From this, we take out the net change excluding the cash account of minus 30,000, and we have the beginning cash balance of 50,000. So the ending cash balance with us remains at $20,000. So based on this, if we look at the major cash inflows, we can see that the inflows have come from bank loans and from long-term debt. And if you look at the outflows, then the outflows surprisingly has come from dividend paid, which the company should not have given, purchase of gross equipment, and purchase of inventory of 100,000. Okay. So if you have to calculate the cash build or burn, then that is nothing but sum of cash flows from operating and investing activities. Okay. So this is minus $105,000. So since the sum of cash flows from operating and investing activities is negative, Castio is burning cash. And if we have to calculate the burn rate per month, we just divide this by 12. So we get 8,750 per month. Okay. Now it is shown here that we have a beginning cash balance of 50,000. Okay. So in 50,000, let us see how many months. Oh, okay. Now it is only 20,000 is available because minus 30,000 was the net change that we had. So since only 20,000 is available with us, how many months will this last us? Since cash available is only 20,000, the company will run out of cash or face a OOK situation. OOK is out of cash in 2.29 months. Okay, so 2.3 months we will be out of cash. So now we have to arrange for financing accordingly. Okay, so this is how cash burn is calculated, cash burn rate is calculated, and how companies understand how quickly they will run out of cash so that they can arrange for financing accordingly. Any doubts, any questions, please ask. Everything is given to you very simply. This question number 7 is also on survival revenues break even. So I think you can do this very easily. Let me look at the others. Okay. Then the 9th one is also on survival revenues, and 10th is also on survival revenues, which again you can solve. It is all very simple. Then the other is also on statement of cash flows and cash burn or build, which again you can solve. We have already done this, so it will not be a problem for you. But students, please solve. Please don't feel that, oh, I've understood, ma'am has shown the solution, it is very easy, I've understood everything, I don't need to practice anymore. Please don't do that. Otherwise you will bear the brunt during the exams. Because in exams, you will be getting a question paper that would be a good mix of both theory and numericals. Okay, so if you don't practice and if you don't bring your queries to class, don't get them sorted out, then you may face an issue during the exam. Okay, so let me wrap up here rather than starting a new chapter today because it's only 2 minutes left anyway. So any doubts, any questions, please ask. Okay, Samriddhi, is this okay?
Yes, ma'am.
Yes, ma'am. Okay, fine. So I think we can wrap up right now, and then we can start with the new chapter in the next class. Okay.
Okay, ma'am.
And Samriddhi, in your email that you will send up, please request everyone to solve the numericals. Okay, not to just keep reading it.
Okay, ma'am. Sure, ma'am.
Okay. Thank you so much. So thank you, Samriddhi, and thank you, everyone. I'll see you in the next class. All the best. Thank you. Bye-bye.
Thank you, ma'am.